$10,000. For a lot of people, that number feels completely out of reach, especially if you're making $35,000, $40,000, or $45,000 a year, and you're already stretched thin just covering rent, groceries, and gas. But here's the truth. Saving your first $10,000 has almost nothing to do with how much you earn, and everything to do with the system you build. Today, I'm going to walk you through the exact strategy, step by step, that lets someone on a low income save their first $10,000, often faster than someone making double their salary who has no system at all. Most people assume that saving is simply a function of how much you bring home every month. If that were actually true, everyone earning a good salary would have a healthy savings account, and everyone earning less would be stuck at zero forever. But that's not what actually happens in the real world. Plenty of people earning $70,000 or $80,000 a year have less than $500 saved, while people earning half that amount have built real, meaningful savings. The difference isn't talent, and it isn't luck. It's a specific, repeatable process, and that's exactly what this video is going to give you. But before we get into the strategies, you need to understand why most people never even get close to this number. Because if you don't fix this one thing first, none of the tips that follow will actually work. Hey! Welcome back to the channel. If you're new here, this is exactly the kind of video we do every week. Practical, no-fluff financial strategies that actually work in real life, not just in some spreadsheet built for someone earning six figures. Today's topic is saving your first $10,000, and I mean genuinely saving it, even if your income right now feels tight. By the end of this video, you'll have a complete, realistic roadmap, the mindset shift that makes saving actually possible, 10 specific strategies you can start using immediately, the most common mistakes that quietly sabotage people's savings, and a 90-day action plan that turns all of this into something you actually do, instead of something you just watch and forget. Now here's the real question everyone asks. If my income is already tight, where exactly is this $10,000 supposed to come from? Let's be honest about something most personal finance content won't tell you. If you're living paycheck to paycheck, the idea of just save more feels almost insulting. You're not being careless. You're not buying lattes every day and ignoring your finances. You're doing your best with what you have, and it still feels like there's nothing left at the end of the month. Here's the part that changes everything though. Saving isn't primarily a math problem. It's a systems problem. Two people earning the exact same salary can end up in completely different places 5 years from now, one with $10,000 saved and one with nothing, not because one of them is smarter, but because one of them built a system that worked automatically and the other relied on willpower alone. Willpower runs out, systems don't. Think about someone named Sarah, a server making around $32,000 a year in tips and hourly wages. On paper, she has almost nothing left over each month. But over 3 years, she managed to save just over $9,000. Meanwhile, a friend of hers making $58,000 a year in an office job had less than $1,000 saved in that same period. The difference wasn't income. It was that Sarah built a system, and her friend just hoped things would work out. Here's another example worth mentioning. A warehouse worker named Marcus, making $17 an hour, roughly $34,000 a year before taxes. He had 2 kids, rent, a car payment, and every reason to believe saving was impossible for someone in his position. But over about 2.5 years, using nothing more complicated than a $30 automatic transfer every payday and a few of the strategies we're about to cover, he crossed $10,000 in savings. He didn't get a raise. He didn't win anything. He just built a system and let it run. The point of these examples isn't to make you feel like you're the only one struggling. It's to show you that this specific number, $10,000, is genuinely achievable on a low income as long as the approach is right. And the approach starts with completely rethinking how saving actually works, which brings us to the single most important concept in this entire video. So let's talk about that system, starting with the single biggest mindset shift that makes everything else on this list actually work. The core idea is something called paying yourself first, and it completely flips the way most people handle their money. Most people do this. Paycheck comes in, bills get paid, groceries get bought, some fun money gets spent, and whatever happens to be left over at the end of the month, if anything, gets saved. The problem with this approach is obvious once you say it out loud. You're saving last, which means you're saving whatever scraps are left, which is usually nothing. Paying yourself first means the moment your paycheck lands, before you touch a single bill, before you buy groceries, before anything else happens, a set amount moves straight into a separate savings account. You then live off what's left. This isn't about having more discipline. It's about removing the decision entirely. When saving happens automatically before you can spend the money, you're not relying on willpower at 9 p.m. when you're tired and tempted to order takeout. The money is already gone from your checking account, already safely tucked away, before temptation even has a chance to show up. This single shift is responsible for more successful savers than any budgeting spreadsheet, any app, or any amount of financial knowledge. It's not about knowing what to do. Most people already know they should save more. It's about making the system do the work instead of your motivation. There's also a psychological piece to this that's worth understanding. Every time you make a spending decision, your brain is weighing an immediate reward, the coffee, the takeout, the impulse buy, against a future benefit that feels abstract and far away, like a savings goal 6 months from now. Immediate rewards almost always win that mental battle, which is exactly why relying on willpower alone fails so often for so many people, regardless of how disciplined they think they are. Automating your savings removes you from that decision entirely. The money is saved before your brain even gets the chance to weigh the options, which is precisely why this one shift outperforms almost every other savings tip combined. It's also worth addressing a common objection here, because I know exactly what some of you are thinking. I genuinely don't have anything left over to automate. That's a fair concern, and it's exactly why this next part matters so much. The amount you start with should be uncomfortable enough to notice a little, but never so large that it forces you to choose between saving and paying an actual bill. For some people, that starting number really is just $10 a paycheck. That's completely fine. The goal in month 1 isn't the amount. It's proving to yourself that the system works, so you can build on it with confidence later. Now let's get into the 10 specific things that make this system actually work, even on a tight income. First, automate a fixed amount, no matter how small. Set up an automatic transfer from your checking account to a separate savings account the day your paycheck hits, even if it's just $20. The amount matters far less than the habit. Once the system is running, you can increase the amount later. Most banks let you set this up in under 5 minutes, and once it's automated, you genuinely stop thinking about it. A good rule of thumb is to time this transfer for the exact same day your paycheck deposits, so the money never really sits in your checking account long enough to feel like it's available to spend. Second, open a high-yield savings account. A regular savings account at a big bank might pay you almost nothing in interest, sometimes as low as 0.01%. A high-yield savings account through an online bank can pay significantly more, meaning your money actually grows a bit just sitting there, instead of losing value to inflation while it waits. Over the course of a few years, on a growing balance heading toward $10,000, this difference can genuinely add up to a few hundred extra dollars that you didn't have to lift a finger to earn. Setting one of these up usually takes about 10 minutes online, and most of them have no minimum balance requirement to get started. Third, use the roundup method. Several banking apps automatically round up your purchases to the nearest dollar and stash the difference into savings. Buy a coffee for $3.40 and 35 cents gets saved. It sounds small, but people using this method consistently save several $100s a year without ever noticing the money leaving their account. What makes this so effective isn't the amount, it's that it requires zero ongoing effort or decision-making once it's turned on. It just quietly works in the background, purchase after purchase. Fourth, save windfalls immediately, before you feel them. Tax refunds, birthday money, work bonuses, cashback rewards. The moment unexpected money lands in your account, move a large chunk of it straight to savings before it blends into your regular balance and quietly disappears into everyday spending. A simple rule that works well here is the 80-20 split. Why? Put 80% of any windfall straight into savings and let yourself enjoy the remaining 20% guilt-free. This way, you still make real progress on your goal without feeling like every unexpected dollar has to be sacrificed. Fifth, do a 30-day no-spend challenge on one category. Pick one category, takeout, clothes, subscriptions, whatever tends to drain your money, and cut it completely for 30 days. This isn't meant to be permanent. It's meant to show you exactly how much that one category was actually costing you, which usually shocks people into changing their habits long after the challenge ends. Many people who try this find they don't even miss the category as much as they expected, and they end up voluntarily keeping their spending lower even after the 30 days are officially over. Sixth, negotiate your bills once a year. Call your internet provider, your phone carrier, even your car insurance company, and simply ask if there's a better rate available. This single phone call, which takes maybe 15 minutes, regularly saves people anywhere from $20 to $100 a month, money that goes straight into your savings goal without cutting anything from your actual lifestyle. Companies expect a certain number of customers to threaten to leave every year, and many of them have retention discounts they simply don't advertise unless you specifically ask for them. 7th, use a separate account you don't carry a card for. Keep your savings account at a completely different bank than your everyday checking account, and don't request a debit card for it. Making it slightly inconvenient to access is intentional. It adds just enough friction that you won't casually dip into it for non-emergencies. If transferring the money back takes even one extra day, that small delay is often enough to make you reconsider whether you actually need to spend it, and most of the time, you'll realize you don't. 8th, sell what you're not using. Most people have somewhere between $500 and $2,000 worth of things sitting around their home that they haven't touched in over a year. Old electronics, clothes, furniture, tools. Selling even a portion of this can jumpstart your $10,000 goal significantly faster than you'd expect, and it costs you nothing but a bit of time. A good approach is to walk through your home room by room once and simply photograph anything you haven't used in the last 12 months, then decide afterward what's genuinely worth listing. 9th, add one small income stream. This doesn't mean starting a business. It can be as simple as picking up a few hours of delivery driving, tutoring, freelance work, or selling a skill you already have online. Even an extra $150 to $300 a month, saved consistently, meaningfully speeds up your timeline to $10,000. The key here is treating this extra income as untouchable the moment you earn it. Since you weren't relying on it before, you won't actually miss it once it goes straight into savings instead of your regular spending. And 10th, track your progress visually. Whether it's a simple spreadsheet, a savings app, or literally a paper thermometer chart taped to your wall, seeing your progress toward $10,000 visually makes an enormous psychological difference. People are far more likely to stick with a goal they can actually see moving, rather than one that only exists as an abstract number. Some people even break the $10,000 goal into 10 separate $1,000 milestones, so they get a small sense of accomplishment far more often than waiting for one single distant finish line. Beyond these 10 core habits, there are a few smaller adjustments worth mentioning that work especially well for people on tighter incomes specifically. Meal planning around what's already on sale that week, rather than picking a recipe first and buying whatever it requires, routinely saves households $50 to $150 a month on groceries alone. Using cashback credit cards responsibly and paying the balance off in full every single month without exception can add another small trickle of savings without any extra effort. And reviewing subscription services once every few months, the streaming platforms, the apps, the memberships you signed up for once and forgot about, often uncovers $20, $30, sometimes $50 a month in charges for things you're barely using anymore. Those are the 10 strategies, but here's something just as important as knowing what to do. You also need to know what not to do, because a few common mistakes quietly undo all of this progress for a lot of people. Let's talk about the mistakes that derail people even after they've started saving. The first mistake is treating your savings account like a backup checking account. If you keep dipping into it for non-emergencies, a concert ticket here, a nice dinner there, you'll never actually build momentum because you're constantly refilling a bucket that has a hole in the bottom. The second mistake is trying to save too aggressively, too fast. Cutting your spending down to nothing for the first month often backfires because it feels like punishment rather than progress, and most people abandon a plan that feels miserable within just a few weeks. Start with an amount that's genuinely sustainable, even if it feels almost too small, and increase it gradually as the habit sticks. The third mistake is comparing your savings journey to someone else's, especially online. Someone posting about saving $5,000 in a month likely has a very different income, different expenses, or no debt at all. Comparing your situation to theirs isn't motivating, it's discouraging, and it has nothing to do with your actual progress. The fourth mistake is not having a clear reason behind the $10,000. Saving money just because you should rarely sticks. Saving money because it's your emergency fund, because it's a down payment on a car, because it's the start of financial independence. That specific reason is what keeps you going on the days motivation runs low. There's a fifth mistake worth mentioning too, and it catches a lot of people off guard: giving up completely after one bad month. Life happens. A car repair, a medical bill, a slower month at work, and sometimes you'll have to dip into savings or skip a transfer entirely. That's not failure, that's just real life. The mistake isn't the setback itself, it's treating one bad month as proof that the whole system doesn't work and abandoning it altogether instead of simply picking the transfer back up the following month. Every single person who's ever successfully saved $10,000 has had at least one month where things didn't go as planned. The difference is they kept the system running afterward instead of quitting. Before we get into the actual plan, let's do a quick reality check. 3 signs that tell you you're on the wrong track so you can catch them early. Here are 3 warning signs that your current approach isn't actually working, even if it feels like it is. Sign number 1. You keep starting over on your savings goal every few months because you keep draining the account back to zero. Sign number 2. You have no separate account at all, and your savings just live mixed in with your regular checking account, where they quietly get spent without you even registering it as spending savings. Sign number 3. You've never actually calculated how much you need to save each month to hit $10,000 by a specific date. You're just saving whatever's left, which, as we talked about earlier, is usually nothing. If any of these sound familiar, don't worry. That's exactly what the next part fixes. Here's your actual 90-day plan to get this moving for real. In the first 30 days, your only job is to set up the system. Open a high-yield savings account at a different bank than your checking account. Set up an automatic transfer for whatever amount feels sustainable right now, even if it's just $25 a paycheck. Track every expense for the full month so you can see exactly where your money is currently going, without judging yourself for any of it yet. In the next 30 days, your job is to optimize. Pick 1 or 2 of the 10 things we covered that fit your life the best. Maybe it's negotiating your bills. Maybe it's selling unused items. Maybe it's picking up a few hours of side work. Use what you learned from tracking your expenses in month 1 to identify one category you can meaningfully cut back on, even by a small amount. In the final 30 days, your job is to build momentum. Increase your automatic savings transfer by whatever amount you can comfortably manage. Do a check-in on your progress and celebrate it, even if you're not close to $10,000 yet, because building the habit is the actual win in these first 90 days. The dollar amount will catch up once the system is running smoothly. By the end of these 90 days, you won't necessarily have $10,000, but you'll have something more valuable, a working system that keeps building that number automatically, month after month, without requiring constant willpower or motivation. To give you a realistic sense of timelines, if you're able to save $150 a month through a combination of these strategies, you'd reach $10,000 in a little over 5.5 years. If you push that to $250 a month, you'd get there in just over 3 years. And if you combine automated saving with one of the extra income strategies we covered, pushing your monthly total closer to $400, you could realistically hit $10,000 in about 2 years. None of these timelines require a 6-figure salary. They require consistency and a system that runs whether or not you're feeling motivated on any given day. It's also worth saying clearly, your timeline doesn't need to match anyone else's. Someone with fewer expenses, no dependents, or a bit more flexibility in their budget might reach this goal faster than you, and that's completely fine. The comparison that actually matters is between you 6 months ago and you today. If that number is moving in the right direction, the system is working, regardless of how fast it's moving compared to someone else's situation. Before we wrap up, let's quickly address a few specific situations, because I know low income doesn't mean the same thing for everyone watching this. If you're a single parent, your biggest asset in this whole process is going to be adding a small income stream. Even a small flexible side income, worked around your schedule, tends to move the needle faster than aggressive budget cutting, simply because there's often less room left to cut from an already tight household budget. Look for income streams that fit around your kid's schedule rather than fighting against it. Tutoring in the evenings, selling handmade goods, freelance work you can do after bedtime. If you're paying off debt at the same time as trying to save, you don't necessarily have to choose one or the other completely. A common approach is to keep a small, automatic savings transfer running, even just $25 a paycheck, while putting the majority of any extra money toward high-interest debt first. This way you're building the saving habit and a small safety cushion, while still making real progress on debt that's costing you more in interest than your savings account could ever earn you. If you're a student or just starting your very first job, your advantage is time, even if your income is genuinely minimal right now. Getting the automated system running early, even with just $10 or $15 a transfer, builds a habit that will carry you through every raise and every new job for the rest of your working life. People who start this habit early rarely have to learn how to save later. It's already just how they handle money. And if you're dealing with an irregular income, tips, freelance work, gig work, commission-based pay, the fixed dollar amount approach can feel difficult some months. Instead, consider saving a fixed percentage, like 10% of whatever you earn that particular week or month. It flexes with your income automatically, so you're never trying to save a fixed number you simply don't have during a slow month, but you're still building the habit and the balance every single time money comes in. Let's also quickly cover a couple of questions people almost always ask at this point. What if an emergency wipes out my savings before I hit $10,000? This is genuinely common, and it doesn't mean you failed. If your savings account did its job and covered an actual emergency, that's exactly what it was there for. Once things stabilize, you simply restart the automatic transfer and keep going. Your $10,000 goal isn't erased, it's just delayed, and delayed progress is still progress. Should I pause investing to focus only on this $10,000? For most people on a lower income without much saved yet, building this initial cushion first makes sense before investing seriously, simply because having accessible cash prevents you from having to pull investments out early during an emergency, often at a loss. Once you're a few $1,000s in, it's completely reasonable to split new contributions between savings and a small retirement account, especially if your job offers any kind of employer match, since that's essentially free money you don't want to leave on the table. What if my income is genuinely too low for even the smallest transfer? In that specific situation, the priority temporarily shifts to selling unused items and finding even a small extra income stream, simply to create enough breathing room to start the automated savings habit. It's not that saving is impossible, it's that the starting point looks slightly different depending on where you're beginning from, and that's completely normal. Let's recap everything we covered today. Saving your first $10,000 isn't primarily about income. It's about building a system, starting with paying yourself first, so saving happens automatically before spending ever gets the chance. We covered 10 specific things you can do, from automating small transfers and using high-yield accounts, to negotiating bills and adding a small income stream. We talked about the common mistakes that quietly derail progress, like treating savings as a backup checking account or saving too aggressively too fast. We covered 3 warning signs that your current approach needs adjusting. And finally, we laid out a complete 90-day plan that turns all of this into real, consistent action. Remember this, the $10,000 isn't the actual goal. The system you build to get there is the real goal, because that same system will carry you to your next $10,000 and the $10,000 after that, far more easily than the first one. The first $10,000 is always the hardest, simply because you're building the habit from nothing. Every dollar after that gets easier because the system is already running, the account already exists, and the discipline has already become routine instead of something you have to force yourself into every single month. If this video actually helped you, hit that like button and subscribe, because we put out videos just like this every single week, walking through exactly these kinds of practical, real-world strategies rather than generic advice that only works if you're already earning a lot. Drop a comment and let me know, which of these 10 things are you starting with first? I genuinely read through these, and it helps to see where everyone's actually starting from, whether that's automating your first small transfer this week or finally making that one phone call to negotiate a bill you've been putting off for months. In the next video, we're covering what to actually do once you hit that first $10,000, where that money should go next, and how to make it start working for you. So make sure you hit that bell icon so you don't miss it. See you in the next one.